Welcome. My name is Sasha Moore, and I'm delighted to moderate today's 2025 Market Indicators Live webinar with industry veteran and financial services specialist, Nick Young, who's also the Managing Director and founder of the leading trailbook company, Trail Homes. We're also joined by Stephen Watson from the residential brokerage Lending Loop. Welcome both. So in this session, we'll be overlaying Australian Bureau of Statistics data, or ABS data, with market conditions to provide some insights on the state of the market compared to 12 months ago, core drivers and changes in consumption and borrowing patterns, big picture macroeconomic contributors and how they're affecting the state of play, and top tips to keep current clients warm whilst attracting new aligned clients. Lastly, we're going to finish up with some expectations for 2025, so what to look out for in the coming months. We love questions, and we absolutely encourage you to feed in any questions that you have for the panel via the chat function, and we'll address these at the end of the session, or if it is relevant to a particular section, we'll fire those through to Nick and Stephen. So welcome, Nick. Great to see you today.
Thank you, Sasha. Great to be here as always. And thank you for the very kind words introduction.
No, we always love your insights. So the reason that we have both Nick and Stephen on panel is Nick is going to give an overview from sort of that macroeconomic perspective, and then Stephen's going to, from a broker's perspective, provide some on-the-ground insights. So welcome, Stephen.
Thanks, Sasha. Happy to be here. Awesome.
So Nick, over to you. What we're going to do, everyone, is go through some ABS data, because the interesting thing about doing that is it gives us historical indicators, or we can look at historical patterns that will then give us clues about what's coming next. So it's not a crystal ball session by any stretch, but the thing that I always love about doing these sessions with Nick is he's got such a rich financial knowledge, and having been through many markets, whether it's GFC or COVID or whatever the case may be, there are certain indicators or certain clues we can take from historical patterns to give us an indication of where we're at right now. So Nick, over to you. What have we got to start with?
I'm a little bit uncertain about your introduction there, because it makes me just sound like I'm just too old and I've been around for so long that,
Oh, no, I think you mean experienced.
But you're right, Sasha. So as everyone can see here, I've got open, well, hopefully one can see, a page from the Australian Bureau of Statistics. So this is by very much public information. You can go to the ABS and put in lending indicators, and you will get up this page. So we're just going to run through it as Sasha says. I'm not going to go through it in every single graph that's in here, but I think there's a couple here that are really interesting. I follow them religiously, and I think it's probably one of the, as far as a mortgage broker is concerned, it's one of the most interesting source places that you can go to. So these documents were released, as it says here, earlier this month, and you can see that another one's due next month. So they come out every month. So the first graph is this one. So this is, if you're a residential mortgage broker, this is the barometer. Now, I think there's a few things in here that are interesting. The first of all is this, and we've spoken about this before, this big lump here. Now, that is COVID. And that is the Australian government, effectively through quantitative easing, cutting interest rates, trying to pump the Australian economy, trying to keep the economy whirring along. Now, you don't have to be a scientist or an economist to look at this and go, they pumped it too hard. The economy was running along here, and they broadly almost doubled lending. And with the benefit of hindsight, they should have cut it off earlier, the quantitative easing, and they probably shouldn't have gone as hard as they did. It's very easy, though, with the benefit of hindsight. Now, we as mortgage brokers, we love a party, and that is damn good fun for us. That is us in the middle of the party at about 11 o'clock at night. Things are absolutely roaring. It is fantastic. You wouldn't like to be anywhere else in the world. Unfortunately, where we're at now is that the RBA is trying to get us to go home and stop the party. Now, where it's interesting is that if you say, okay, so where have they tried to stop the party, or where has the party stopped before? You have to go all the way back down here to 2008. So it doesn't look so dramatic on this graph because of sort of what happened afterwards. But if you were there in June 2007, lending was running at about 18 billion a month. If you went forward a year, September 2008, it had dropped to 13. It was about a 50% fall. So if you're a mortgage broker back then, having your business turned down, or the underlying business turned down by 50%, it hurt. It hurt big time. Now, that's broadly what I would have expected to happen when they tried to turn the party off this time around. So we were running at 30-odd billion dollars a month. I would have expected it to get down to about 15 billion, so down about here somewhere. Now, in reality, what's happened is we've gone back to sort of 23s, which is sort of back into what you might call long-term trends, but it hasn't actually slowed the party. What's actually now happening is lending is now climbing back up again. This actually is a problem. It's good for us as mortgage brokers because it means the party's starting to get going again, and we're starting to write more tickets. It's great news. Down at the RBA, they are holding interest rates where they are because they're desperately trying to slow the economy. They actually don't want to see this. That's the bad news. They would prefer to see this continuing to head down, certainly not heading up. Now, if you then go to the underlying game, it, I think, gets even more interesting. The RBA has actually got a problem here. So I'm prattling on a bit here, Sasha, and jump in if you want to.
No, but I think it's really important, Nick, because I think it's natural. And again, as you've correctly presumed, you look at this from a general perspective and you think, fantastic, lending's going up. So therefore the economy is more stable and the economy is more buoyant. So, and we were just having a bit of a chat offline about the types of lending and the different patterns and so forth that we're seeing. And I think it's actually really critical to unpack this in terms of this juxtaposition of spending versus RBA's expectations, because obviously that has a myriad of ramifications. So Nick, I would love for you to continue to go through this in detail. And then Stephen, it'd be great if you can also, upon Nick's conclusion, just interject in terms of what you're seeing on the ground.
So, I mean, I assume, Stephen, that you're seeing a pickup in activity and you're enjoying some of this lending.
Yes, certainly. And I was just actually, while you were talking, I was going some of the deeper data, Nick, in regards to the investor activity. And it's actually fairly scarily, surprisingly spot on for the stakes on what I'm seeing at the moment as well. I think you'll probably show that detail anyway. Sure.
Well, it's unfortunately all based on fact. It's not an opinion.
Yeah.
So Nick, please continue to give context, and I love also the contextual insight in terms of the historic trends in terms of where we're at now.
So where we're at now, and this is again where it gets really interesting. So if you're a mortgage holder, and in fact CBA, they have a household spending data that they release regularly, and again I think the latest release from them really captures what's happening. If you are a renter or a mortgage holder, you are finding it tough because interest rates are high. So their spending last month down. If you then go to those people who don't have mortgages, their spending up. If you then go to things like aeroplane travel, if you try and book a ticket to go to Europe or America and try and want to fly first class or business class, you will find it really expensive. You want to fly economy, it's actually quite cheap. It's not a problem. So what's that tell me? Rich people are having a lovely time. The Australian share market is at all-time highs. I think we're actually just probably yesterday hit a new all-time high. The US market is high, gold's high. Anything you want to invest in, the price of real estate, up. You put money in a bank, term deposit, up. If you're a self-funded retiree, life could not be better. So those people having a lovely time. They're out there spending, and in fact, they're spending more. The RBA, as I've mentioned, is trying to slow the economy. So they've only got one lever, and that's interest rates. So they are trying to put interest rates up or hold interest rates to try and slow the economy. And in many respects, we've actually got another part of the economy that's actually, in some respects, celebrating high interest rates because I just get more money for my term deposits. This is fantastic. It's a real problem. I'll give you another one. Ingham's. We had a headline as we were promoting this little session about chicken consumption. So Ingham's, as you're probably aware, is the largest supplier of chicken in this country. Now, chicken is an interesting meat because it's the major staple of fast food. Now, you go and talk to Ingham's and they'll tell you that sales are sort of okay. But what we have noticed, fast food sales have dropped away significantly. Supermarket sales have actually gone up. So what they're saying is that people are giving up on their fast food and actually going to a supermarket to buy their food. We've also seen general meat consumption go down. Now, again, that's not because people are turning to a more healthy diet. This is happening over the last few months. This is about people who, mortgage holders, renters, finding it tougher. They're pulling in their belts. But it's really not coming through in the numbers because we've got, as I say, this other section of the economy which is piling away, having a lovely time.
So Nick, can I just pause on that because the chicken consumption piece, which obviously anyone who's seen the campaign or campaign graphics, was something that I found just really extraordinary when Nick and I were just first brainstorming this session. And Nick, I wanted to just go into that a little more because you've mentioned that chicken being the most commonly utilized meat in fast food. Why specifically, if you can just go into the detail of why specifically that takeaway piece going down is so important in terms of people's lifestyle and then what that means about broader consumption patterns being a truer indication of where the market's at?
Yeah, so for better or for worse, if we think about McDonald's, KFC, it's mostly, there's a big skew which is well known towards people on a sort of a lower socioeconomic grouping. It's people on lesser incomes actually spend a disproportionate amount of their income on fast food. We're talking here a lot of single people. We're talking people on lower incomes. That's where they've been historically spending more of their money than a self-funded retiree who you often won't find in McDonald's. So that's the skew. Those people are the ones who are finding it tough. Those people who are on the lower incomes, they're the ones who are, cutting back on shopping at McDonald's. That's the blunt take of it. I'll give you another one. Nick Scali Furniture reported yesterday. Now, Nick Scali Furniture have reported that their sales, so Nick Scali's sort of slightly upmarket. It's not the most expensive place in the world to buy your furniture, but it's certainly more expensive than IKEA. Their sales up. Their profit was down. Their costs are going up. Their cost for freight has gone up big time. They're having to ship. They can't ship through the Panama Canal anymore. They have to ship all the way around the bottom of Africa. And their staffing costs have gone through the roof. So the next step, everyone expecting Nick Scali is going to put up the cost of their furniture. It's inflation. Exactly the thing that the RBA is trying to close down. So what will happen, Nick Scali will put the prices up. They'll still sell. Their share price is actually, a lot of people are saying it's a buy because the underlying demand is good. So they're just going to restore their profit margin. It's a double whammy as far as the RBA is concerned. Their bastards are buying more furniture and they're paying higher prices for it. It's exactly the thing they're trying to stop. It's not good.
And I think you raise a really interesting point because I've never really contemplated an economy of such a wealth disparity.
Yeah.
And it feels like we're dealing with two very distinct beasts, which are in direct conflict. Would that be a correct?
Yeah, no,
Stephen,
it's
what do
exactly
you
right. It
see?
is and it's becoming more and more apparent, and it's about the fact that we're getting this skew of baby boomers now who make up, a large chunk of the population, and a lot of these baby boomers are actually smoking cigars, no mortgage, and life's pretty good. And so we're getting, the tax burden is falling onto a smaller and smaller group of people, and it's a real socio-economic problem which we need to address. That's a whole another session.
Yeah, we'll solve that in another session. Stephen, I'd love to hear your thoughts. I'd like to hear your thoughts twofold. Firstly, in terms of what you're seeing in comparison to this ABS data. And then secondly, what divide, or if any divide, you're seeing in terms of this wealth disparity that we've been unpacking?
Yeah. So I think just to concur on what Nick's saying, and I like to put things into quite simple terms. So this time kind of last year, I would have been lucky maybe to get one phone call every 2 or 3 months for someone that is struggling with their mortgages or needs help kind of with budgeting expenses, right? Probably getting 2 of those phone calls a week at least at the moment, right? And what I'll probably say where I'm seeing it more prevalent is probably not the person that owns one property, the people that own the 2, 3, 4 properties basically in that range. So at a fairly good, existing client of mine holds 5 properties, one of those being the owner-occupied property. Probably looking back now, overextended himself to get into that owner-occupied. And with all the commentary that's happening in Victoria with the land tax, stuff like that, he's given me a call to basically say, Steve, where do you see things, right? And, for me, I am very European by nature. And what I mean by that is I'm a big believer on basically holding assets, paying down the debt, acquiring them, and getting to a point in life where you can realise the cash flow on those properties, right? So my advice to basically that person is if you can financially manage it, I'd suggest that basically you keep the properties, right? Because obviously 3 of the investment properties are in Victoria, right? And we know that it's if he goes to sell them right now, he's probably not going to maximise what those prices are going to be. However, if he's finding that he's not able to keep up the loan commitments, then obviously you're going to have to look at a debt reduction strategy, right? Those conversations that I'm saying, we're probably having at least a couple of those a week at the moment. In terms of the people that don't have many liabilities at all, I completely concur with Nick. Those people are living really, really well at the moment. So, I was talking to a couple of first home buyers. They're probably one of these type of people that, they've had the deposit for basically 20 years, that they're living in the good apartment in basically South Yarra, right? But, they're between 45 to 50 and they're looking at now, what's my retirement strategy going to be, right? And so, those, when you look at the living expenses for those people, you're seeing that they're spending thousands of dollars basically on dining out. It's funny, Nick, when I was looking at their bank statements, yes, recently going to Europe, basically business class, right? Saw what those flight tickets actually were on that file, and they were exorbitantly basically expensive. And the conversation very much around those people was, Steve, where do you see interest rates? What do you think we're going to have to sacrifice here because we still want to maintain this lifestyle, right? And when I'm discussing, what the potential loan repayment's going to be, on $1 million, and, bearing in mind they're 45 to 50, you're not going to be recommending ideally at a 30-year loan term because you want them to obviously have the property paid off prior to retirement, right? They're looking at that figure and saying, gee, if we do this, Steve, we're really going to have to sacrifice some of what we're doing. So yeah, I think there's a pretty a big difference at the moment between the people that have the liabilities and the people that don't have the liabilities right now, Sasha.
And that's actually an interesting point as well, because I would expect, and by all means, both of you challenges, I would expect that those people who are used to a more affluent lifestyle are getting a bit of a rude shock about maintaining that. So whether or not, you know, that in itself will help curb spending, because, you know, as we're talking about, you know, whilst they may be in a position where they are used to having quite a lot of disposable income, what that's then buying is becoming far more restricted. So Nick, do you think that that would be a natural dampening on or slowing of spends, even for a more affluent group, because the cost of everything is going up so much? Or do you think they're fairly price immune?
Yeah, I mean, I sort of take the even, you know, more macro approach here. The RBA always wins. They do not lose.
Right.
So the economy will slow because they will keep interest rates up, and they'll potentially even put them up higher until the economy slows. And that's the game. They're quite open about it. It's not a secret. It's a fact. So the only question is when it starts to slow a bit more. So everybody was thinking that it was going to slow sort of now, and we'd actually be enjoying our first interest rate cuts later this year. I think most people are now saying, oh, it's probably now pushed out into next year. Looking at these charts, I go, it's definitely pushed out into next year. There's no way they're going to be cutting interest rates this year. So when will they? You know, February, March, April, I don't know. But it'll be when the economy actually starts to slow.
And Nick, just to ask you a question on that, when we do have the first rate cut, do you think that that immediately makes property prices go up, or what's your thoughts on that, Nick?
No, I don't, because, and this is where we're starting to see it overseas. So we're seeing Canada, the UK, New Zealand. The economy, unfortunately, often doesn't just slow, it actually starts to really slow. And we're seeing some quite significant, 0.5% cuts in places like New Zealand, because they're actually, when it starts to go over and slow, it starts going too quickly. So it wouldn't surprise me that when it does actually topple, it will, and it will slow, that we'll actually see, interest rate cuts coming close together. And, a little bit like when we're in the peak of interest rates going up, when they're really trying to slow the economy, we'll tend to see that when we on the backside. But at the moment, unlike the rest of the world, Australia is still flying along.
So I guess my take on that, Nick, is, and look, I could be wrong. I think you're a lot in these areas. You're a lot smarter than I am, but I think that once people get access to basically cheaper money, very quickly when that happens, I think we'll see an upward trajectory in basically property prices. That's just my own kind of personal opinion. So I'm seeing a lot of people basically wait on the sidelines at the moment. They want to do something, but they're waiting for that first rate cut. And then I think people are going to heavily compete for those properties. And, let's say, we have 2-3 months where we see basically consecutive rate cuts. That's probably going to increase borrowing capacity by 5 to 8%. So my thoughts are what becomes 700,000 becomes 750 pretty quickly.
There's a lot of money still out there. A lot of money out there.
So Nick, let's maybe move on to the next piece, because I know that we can talk about this all day because it's so riveting. So I find it riveting anyway. So Nick, we'll talk about the external refinancing adjusted values and what this now tells us about where the refinancing piece is.
Yeah, I'm just going to go through some of these charts really quickly now, because they all sort of tell the same sort of story. So external refinancing. So this is somebody with a mortgage, and I'm going to refinance it, and I'm going to take it to a new lender. So again, a year ago, the mortgage wars were underway, and we saw a lot of refinancing happening. That's sort of slowed down. It's still not got back down to what I call historical levels. It's still actually pretty high if you look at, where we were. But, you don't have to be a mortgage broker to work out that the mortgage wars have stopped. What I do find really interesting, and I'm just at the moment trying to get more data on this, and there's actually not nearly as much data around, is what's happening in the business market. So your business loan, and I'm talking about a classic, $10 million own a commercial property, that sort of loan. There seems to be that the mortgage wars have moved from the residential game into the commercial business lending game, and we're seeing really cutthroat rates happening, really aggressive deals, whether it be from the major banks, whether it be from the private lenders. Everybody's now trying to get into this game and win business. So there seems to be a lot of refinance going on in that sector. So I just make that comment. So here we are. Again, a problem for the RBA. So new loan commitments, personal fixed loans. This is car loans. So this is not your payday lenders. This is fixed term. This is, I'd like to buy a new car. Thank you very much, Mr. Car Dealer. It's not slowing. It's just, basically running at record levels. Not good for the RBA. Good for mortgage brokers, potentially. Your shorter term stuff, so this is getting more into your payday lending sorts of things, much more subdued. So again, your battler is actually finding it harder. Now you'd think once the battler finding it harder, they might turn to payday lenders, and well, not so much payday lender, but short-term lenders. They actually, don't. Payday lenders, perhaps they do, but borrowing money to buy a new TV, maybe not. I'll just make do with the old one. Thanks very much. That's a lot more subdued. Business finance, as we talk about, on the way up. So again, consistent with what we're seeing.
Nick, I might just pause there for one moment. Stephen, in terms of what I wanted to do, Nick, before we get into business, can you just pop up to the graph before, please? I'd just like to get your indication, Stephen, about consumer sentiment at the moment. So, we were talking about people sitting on the fence for longer in the residential space, and we work with a lot of commercial lenders, and that's definitely consistent in the business finance space as well. People are sitting on the fence longer. Inquiries are taking far longer to convert. There's a much greater level of drop off and so forth. And the sentiment that I've been discussing with the lenders that we work with is that just consumers are on the fence. They're very cautious about any spending. But having said that, these graphs buck what I'm hearing a lot in the market. So I was just, from a consumer sentiment perspective, whether that's an individual or whether that's a business borrower, I'd just love to hear your take about where you feel individuals and businesses are at the moment in terms of their psyche.
Yeah, I think that what always plays a really big part of when you talk to the consumer is what's on Channel 7 News, what's on Channel 9 News, right? And my father-in-law was a very, very successful financial planner. He retired on about 4,000 clients, and actually he came to Australia when he was 21 years old, couldn't really speak English, was an accountant's clerk for the first kind of 20 years of his career, and then when he was 40, basically became a financial planner once he could speak English, right? And what he always just basically summarise is the smart people will basically do the opposite on what's on the TV, and the gullible people will listen to basically what's on the TV, right? So, for someone basically like me, as I said earlier, I think that when the interest rates basically drop, that will put an upward trajectory basically on property prices. So for me, the perfect time to enter into the market is basically now, because I think people will basically realise that equity, right? And then the other thing is, if they're obviously renting, they're paying off someone else's mortgage and not building their own financial position, right? And when you look at basically the demographic of what comes on a current affair and those type of things, it's not the person ever that basically owns 1, 2, 3, 4 properties, right? It's the person that basically getting the pension, hasn't done the right things with their money, usually basically over the time frame, to put themselves basically in that position. So what I'm kind of saying is the smart people will basically they'll enter, they'll basically take a medium to a long-term perspective on what they're basically doing. It could basically well be that, we do basically see some dips in prices, right? But they're paying off their own mortgage versus building up someone else's financial position. And I think that there will be the large, basically a masses of people that will basically be really waiting for that RBA announcement and be listening to basically what happens on the news before they pull the trigger, Sasha. So that's what I'm kind of seeing there at the moment.
And I think you raise a really interesting point. And I also see this as being more prudent than ever from a broker's perspective. It's very easy to assume financial literacy. And I think that now more than ever, independently of where a borrower's literacy levels are at, that forecasting, and again, preferably in conjunction with a planner or an accountant or whomever is appropriate for that circumstance, that it is a more medium to long-term view, because obviously we have the privilege of knowledge of financial education, and I would expect that a lot of borrowers wouldn't even be in their vocabulary to understand that or potentially take that view. So I would really encourage brokers to take that on board. And I guess that's also a really nice way to make sure you're ring fencing your customers as well, because you're then journey mapping with them, but you're also making sure from a longer term that their goals are being met, but they're not overreaching.
And just to add to that, like we've started doing a lot more referrals, like saying to certain people, yes, basically go talk to your family accountant, or if your parents have got a financial planner, because they might already be in retirement, say, see if they'll give you 30 minutes of their time to basically have a quick conversation, right? There's also like really simple things that we basically do, like on a lot of these graphs when we go lower, like you'll see that Queensland being like a very, very strong market. Like you can almost go to nearly any suburb, look at what properties basically sold for 4 basically years ago, and essentially what they're selling for now, right? And that's not to say that we're going to see the same growth levels, because it's going to be highly unlikely, right? We had a lot of immigration from Victoria and New South Wales basically into Queensland that was really triggered by COVID. And when you look at a lot of these regional areas that have really boomed up, a lot of that's basically sprung from that people aren't required in the office anymore. And that would just be another quick one that I actually say, Sasha and Nick, I don't know if you guys have seen some of the global CEO reports come out, how companies like Amazon and the likes are basically saying we want people basically in 5 days a week. I'm very, very interested to see what areas like the Sunshine Coast, Mornington Peninsula, those type of areas happen, because I've already started to see very small snippets of people that bought in those regional areas that are talking about selling those properties and moving back closer to the city if they're going to be required in the office 5 days a week. And people are going to be faced really with a choice really quickly. If they make it mandatory, I either keep my job, I go somewhere else. But if everyone else is going to follow suit pretty quickly, the grass potentially isn't going to be greener on the other side. So I'm really interested to see what happens with regional markets over the next 12 months.
Indeed. Nick, we might just go back to the graphs because these are all very interesting areas, but I do want to make sure that we're statistically sort of keeping focused and seeing what insights we can glean. So I'll throw back to you, and what we might do is for the next sort of 15 minutes, we'll continue to go through the graphs, and then we might go through to our expectations for 25 and tips for harnessing 25. So back over to you, Nick.
So I think sort of the picture that I would suggest these graphs are giving us is that the moment the party's on, we're on the dance floor. We sort of got off for a bit, had a bit of a breather. We're back on the dance floor. The RBA is trying to move us, trying to quieten things down. So we need to accept that. Probably we're going to be heading into an environment where the underlying level of activity is going to slow a little bit. So that's what the game's going to be. The second bit, I think, is sort of slightly more interesting. Stephen's touched on the fact that you'll have some people in your client base who are finding it tough, and you need to be close to them. You need to be looking after them. That's, we've got a moral duty as much as an opportunity there to do that. So that's an opportunity. The other one is these sort of more affluent people, which comes through in these charts, to focus in on them, because a lot of them actually do borrow. So whether it's borrowing to, invest in a business, buy some shares, perhaps an investment property, which, Stephen was talking about, perhaps now this is the time to, in fact, looking at buying investment property as other people are trying to get out of them. Those people are going to be potentially good targets. So the way I would say that you go after them is probably your accountants. Accountants are always lovely referral partners, but particularly accountants that look after, shall we say, the more affluent clients, but solid clients. Solid clients tend to have a very strong accounting relationship. Get close to those accountants. That's where the opportunities are going to be found. Stephen's touched on, some areas of Australia are going to be better than others. I don't disagree with that. In fact, I very much agree with him. The problem that many mortgage brokers have got is that they're somewhat constrained in the geographical region that they live in. So it's not very, practical to say to somebody in, Victoria, perhaps you should be concentrating more on southeast Queensland. Then again, perhaps you might just join the crowd and move. But potentially if you can, redirect your business to different parts of Australia where we are seeing growth, then obviously now's the time to be doing that as well.
I am seeing people, obviously, Nick, I've only been in industry for just on 3 years, obviously under your group, National Lending Group, but I am seeing a lot more kind of brokers operate basically outside of their geographical. Like I get a lot of people that come to me for a second opinion, right? And I'll say like 7 times based out of 10 when I ask who the other broker is, like they're lucky if they're in the same basically state. Like I say, 50% of the time that they are in basically another state, right? And I think that's where really good smart marketing and referral relationships can come into play. There's no reason why you couldn't have an accountant referral relationship with someone that's based in New South Wales when you're in Victoria, right? Because the reality of how the business is transacted these days is not many people are wanting face-to-face. Most people, I say 80% for me, just happy with a phone call. And the other 20% are just more than happy to have a Zoom meeting, whether that's when they get home in the evening or basically even do it on their lunch break.
Interesting. So that's probably it as far as the charts are concerned, I think. Sasha, we've touched on that one.
Maybe we'll go to business finance.
Yeah, business finance. As I say, just before we were getting onto this, the ABS has data on it, but you've actually got to go to the raw data. They don't put it in nice charts like this. I was looking at what they call medium-sized refinancing, which traditionally has been running at about 3 billion, something along those sorts of lines a month. In more recent times, the last few months, it's been up around 7 billion. So that's a really good snapshot of just how much refinance. It's broadly doubled. And certainly at Trail Homes, where we follow our portfolio of loans very closely, we're seeing those really big loans. It's only certain books that we've acquired over the years, and we know those books have had exposure in part to commercial lending, and we're seeing some of those really big loans being refinanced. So it's just an interesting observation that's where the hot spot in the lending market is, and potentially is an opportunity if you are a broker who is exposed to that sort of market or you're wanting to get into it.
No, indeed. Shall we move through to the next graph about loan commitments for housing?
Yeah, so I think probably these charts now, it's sort of, I don't really have a lot to sort of really say about these ones. I mean, it's they're just telling a very similar story. So it's the message here is that all this lending has started trending back up again, and it's the very thing the RBA is wanting to stop. So that bit there, the RBA doesn't like, and that's what the RBA is trying to flatten out. They want something that looks a lot more like this, and less like that, heading back to this. That would be very alarming for them. So these sorts of things, as I say, it's a similar sorts of story. We're getting at, if you had a long-term trend, we're starting to get up to the top of this long-term trend, and they don't like it. So yeah, no, I think all these charts, they're all telling the same story. Oh, this is interesting. And this won't surprise anybody, and I'll be very surprised if you haven't seen this, Stephen. So back in the middle of COVID, or towards the end of COVID, when all these very cheap fixed rate loans were around, funnily enough, the amount of fixed rate lending was at an all-time high. So we've now seen that post-COVID fall right away and probably down to almost the lowest level ever. And we've seen once again a revival of variable rate lending. The bit I find interesting is that at the moment, I think there is an expectation that interest rates are going to fall maybe this year, but early next year. And I sort of wonder when I look at these charts whether that's right. I sort of unfortunately think it might take a little bit longer. And some of these I never recommend fixed rate loans normally, but some of these fixed rate deals out there are pretty damn good at the moment. And, you'd have to, I think, as a borrower, be looking at them seriously as to maybe I might lock away some. Perhaps not for 5 years, but maybe over a 2-3 year view. I think there's some wisdom in that. What are you saying, Stephen?
Yeah, so I've personally started to just, can't really say recommend, but discuss obviously with clients, because you need to let them ultimately make the decision at the end of the day, or else you get yourself into a lot of trouble. But starting to do a lot more fixed rates. I think I'll say, been discussing that with my brokers, having those conversations over the last 4 to 6 weeks. I absolutely agree with what you're saying there, 100%. When you look at, some of the lenders basically offering, 5.5% basically for 2 years, all it basically takes is, to come ahead in that initial period, and it's fundamentally it's going to be cheaper for them, right? And I usually don't recommend them to do 100% fixed, like potentially maybe going 60% fixed and 40% variable, so they still have some, flexibility, to make those extra repayments. As ultimately as a broker, you really want to encourage that, because fundamentally, if they do just the minimum repayment for 30 years, they're paying an exorbitant amount of interest back to the bank, right? And sometimes I feel like if you give someone 100% fixed, and then the lenders obviously put a cap on how much those repayments can be, you potentially, putting your customers into some bad behaviours, where they're, going to use that money towards cost of living. So yeah, I absolutely agree with you, Nick. Something I've started. It seems like there's a bit of a battle between kind of Macquarie and ING going on at the moment, Nick. They've gone at each other a few times. So yeah, personally, at the moment, I'm recommending a considerable amount of fixed rates.
Yeah. Otherwise, average loan sizes, it's relentless, and that's obviously related to the price of housing. First home buyers, not doing it so well. They're finding it tougher. Surprise, surprise. I don't think there's anything there. We've already worked out that first home buyers, renters are finding it tough. It is what it is.
So I might just interject there, and Stephen, I'm particularly interested in your views. Mortgage stress in terms of where that's at, and then Nick, in terms of your perspective, whether or not there's any correlation with unemployment and those two factors, either separately or combined, as that will affect things moving forward.
Yeah. So yeah, I definitely think there is some mortgage stress there, right, Sasha? And I think we'll only continue to basically see that more and more. Like, typically speaking, when I structure a loan, right, and say it's a first home buyer as an example, or say they're buying a property for 800,000, right? I generally try to work towards rule of thumb, and it's just one of my kind of fundamentals that work for my father-in-law. The value of the property that you basically hold, ideally you keep 5% basically cash in the bank, right? And so usually I'll, if they're buying for 800,000, I'll try to keep them with, 20, 30, 40,000 to stay as close to that, basically that figure as possible. And that's where, like the first home deposit scheme is really good, allows them to put in an extra allow them to put in the 5% deposit, and then they can fundamentally keep the remainder of funds if they have them in the offset account, right? If you're the first home buyers that are, when I'm doing my checking calls or ones that have basically reached out to me, I basically ask them, how much you got in the offset account. And let's say initially when I wrote the loan 14 months ago, they had $30,000. Now they've only got $12,000. Well, that obviously indicates, one, they're not saving any money, but they've used basically their save on top of that, they've used their savings and they've gone basically backwards, right? And if they that same pattern trajectory basically continues, they're going to find themselves in real trouble, right? So I'm seeing that be pretty prevalent. I'll say, particularly on the first home buyer, Sasha. Yeah.
Yeah,
I don't know how that relates to unemployment and stuff, and you can probably more speak to that because good with those numbers.
Yeah, I think this chart's a good chart to just ram home that it's the first home buyers actually finding it tough. The lift in lending is coming from a more affluent borrower, and that's just again what these charts are telling us. As far as unemployment at the moment is actually pretty low, and the RBA is looking for it to actually lift. It's not nice to sort of budget for and want more people to be out of work, but the RBA is looking for our employment numbers to actually start falling or unemployment to rise. It's one of the indicators they're watching, and at the moment it's not really happening. The latest set of numbers actually that came out this week surprised everybody on the upside. Again, it's this very resilient economy. We're on a slightly different path, or perhaps a very different path from what's happening elsewhere in the world. The RBA will win.
And Nick, just staying with you, I know that we've had various conversations about him being relentless and your view about it becoming the sleeping killer of the mortgage game. So I just wanted to touch on that for a minute.
Yeah, so and this is why the RBA does win, because you'll just get more and more people who will get caught in the fact that I just don't have as much money to spend on whether it's takeaway food or Nick Scali furniture. I just have to pull my horns in. It does, as this goes back to the RBA, does win. So HEM is relentless, as you mentioned, Sasha. So because of inflation, and inflation is high, it's too high, HEM every month goes up. So somebody who could service a mortgage with interest rates at that level a year ago, interest rates same level today, can't. Again, none of this will come as any surprise to the mortgage brokers listening in, but it's just another reason why the RBA always wins.
No, indeed. Well, let's maybe move on from the statistics. So Nick, feel free to keep the stats up or remove them from your screen, whatever you prefer. Stephen, I'll start with you. What would be your recommendations to brokers to best ride out this next wave, and next wave being next quarter or two?
Yeah, so I think, you got to always operate in two perspectives, right? You've got your existing customers that you want to maintain and you want to grow, right? And then you constantly need new business that you basically bring on the top on the top of the funnel. So I think what I'm speaking to, I've got 7 other brokers that work for me, right? And what I'm speaking to them about is, just trying to, for the existing customers, break it down into small tasks, right? It's if you basically bring it down to a really small number, like I'm going to call 2 to 3 of my existing basically customers per day, right? Basically do those check-in calls. You can bring it down to a pretty small number. And then if you keep that consistent over a time frame, before you know it, you're touching base with almost everyone, right? And I always like to use the analogy, right? You kill 2 birds with 1 stone. So when you're basically doing those calls, you're finding out whether those customers, whether they need help budgeting, if they're basically feeling it tight, they might need a referral to an accountant, financial planner. In uncertain times like this, something you might want to discuss with them is, do you basically want to review your insurances, right, as well. So you can have those really meaningful conversations And then, by the way, do you know anyone that's basically looking to do something at the moment? And I'll say that's the thing that I see always a lot of people do wrong is they just won't ask that one question at the end. Can you basically help me grow my business? And I do one really small thing, right, Sasha, every time I have a settlement, and I find this is something that works tremendously well for me. I'm not one to, and I say that, and it's a bit contradicting to like when I'll have a settlement to immediately ask them for a referral, right? But what I will let them know is that by basically letting me write their loan and helping them, they've allowed me to put food on the table for my family, right? And what I find is when you can bring it down to basically a meaningful level with customers and to let them know that, hey, they've been obviously hopefully really happy with my service and I've done a great job for them, right? But then they know they've actually helped me back in turn in some way as well. Take it from like a business relationship then down to like a personal relationship, right? And I use the words with customers that, you know, I never take any settlement or any basically loan for granted, right? And when people feel like they're measuring with you on that level, they're going to feel like obligated basically in turn to basically get your name out there and to provide you business. I think in terms of, you know, just focusing obviously on topping up the pipeline and speaking to new prospects. Really these days you've got to be doing everything right. Like you've got to have referral partners. You've got to be basically doing social media. It's not just one thing. You need to be doing lots of things in combination, right? And you know the typical thing that you know I end up seeing is for me, too many brokers, they spend time on, you know, writing the loans and the fulfillment and the service of them when they really need to be unleashing their sales basically on the other side. So as, you know, broker market shares reaching an all-time high in terms of competitiveness, right? You need to make sure that you've got those systems and processes in place basically on the back end that allows you to basically get out there and do the things that are actually going to generate you revenue and give you a business at the end of the day.
No, indeed. And Nick, I think that that's also consistent with your views about having a concurrent strategy for really nurturing your existing customers as well as acquiring the right or most aligned type of new customers. So with that segue, what would be your recommendations for brokers at this point in time?
Yeah, like, that was the Nick, sorry. Yeah, go ahead. Yeah.
Sorry, I was actually just I'm going to, if I may, Sasha, just sort of deviate off to the side. You always hate when I do things like this.
No, I love that. Go off piece, knock yourself out.
So I just think it's interesting. I've been every time I meet somebody senior in the industry over the last sort of month or so, I've been asking them the question: in 3 or 4 years' time, do you reckon there'll be more lenders in the industry, more mortgage brokers, sorry, in the industry, or less mortgage brokers in the industry? And it sort of surprised me the first time I heard the answer, and that's why I've kept on asking it. And the answer's coming back consistently. Every single senior aggregator broker that I talk to, they're all saying I expect to see less brokers in the industry in 4 or 5 years' time. So these are what I call the really experienced people in the industry, have been around for a while. So they're all saying that broker market share will continue to increase. We'll take more away from the branch networks, but the actual numbers of brokers will decrease. I just think that's really interesting. So you can play into that and say, right, I'm going to be one of the survivors, which, yes, is about servicing your clients. It's about being really close to them. There's also an opportunity to build your business, because what that means is that survivors are going to have much bigger businesses. So I need to be scaling up. I need to be thinking about how I can, actually handle increased volumes. Or perhaps for other people, it's about thinking, okay, maybe I should be thinking about how to maximize my sale price and really plan my run to exit the industry and be one of those affluent baby boomers fighting over the first class seat in the aeroplane.
I think it's actually a really interesting question to ask, and a really interesting consideration in terms of the industry, because I guess with the growth of any industry, mortgage broking or other, there's going to be a change of dynamic in that sector. So it, to me, would make absolute sense that the composition of the mortgage market will naturally evolve because of the various plays, etc. So I think yeah, it'll be an interesting time to see how this materializes. And I know just from my perspective, whenever I'm, you know, at conferences or speaking or other, there's a definite shift in the style of conversations that I'm having with brokers now than a few years ago, where it is more futuristic, it is more from a business lens, opposed to that very sort of legacy association of, you know, trail lens and so on and so forth. So I think that the sector is definitely evolving. So it'll be interesting to watch this space. But before we leave, I would like to just start with you, Steve, and then Nick. If I can get your insight. So in a snapshot, what are you predicting for 2025 to look like, and how do you think the industry can best respond to that?
Nick, you go first. I want to hear what you have to say.
Well, as I keep on saying, the RBA will win.
Yeah.
So the economy will be slower next year. That's the whole point. I hope we do have this idea of a soft landing. I think it still is possible. I've said previously, though, the target or the landing pad is getting smaller and smaller. I still agree with that. And we're seeing overseas that as these other economies are being brought into land, in many respects, New Zealand, we're seeing it right in front of our eyes. Canada, we're starting to see it. They're actually coming in, not for crash landings, but it's, you know, it's certainly not a soft landing. It's not a hard landing, but it's not as soft as they would have liked. So we've got that in front of us. Stephen touched on the fact there is a lot of cash out there still. So, you know, potentially, I think we have got perhaps more opportunity. We are a lucky country to come into a soft landing, but the overall theme is that I think we've got to slow. We've actually got to get off the dance floor. Perhaps just to retire to the bar rather than sort of go home and have a hangover. And that'll be a good result.
Thank you, Stephen.
I think Nick says everything Nick said there is right, and I'd agree with. You know, if I was to summarise it, Australia's a very, very resilient country. when you measure up to Australia to a lot of other places, yes, you know, we've had things happen in the economy previously, but, you know, nowhere near to the extent as like a lot of other countries, right? You know, when you look at, you know, some countries like how their currency basically decimated, right? Australia's obviously very, very far away from that. It's you know, you can't like dispute the data, right? That you know, Nick is right in the sense that you know, levels of lending will need to come down for that probably to happen. You know, for someone like me, I'm probably living in the moment. I like what's happening at the moment, but from a
on the dance floor.
You know, from a realistic perspective, yeah, like it is basically going to have to slow, and the further, obviously, that it doesn't, obviously, the more risk that there is for the economy at the end of the day. So just before I finish up, I just wanted to go back to Nick there just really quickly. Nick, when you're talking to those senior people, because I agree with you, and I don't know if the reasons are the same for me about how you think there'll basically be less brokers. What you might have said it, Nick, I might have missed it, but what are the 2 or 3 key reasons why you think that would be, Nick?
Well, it's not so much my view, it's what I'd call other people in the industry's view. It's more that I don't disagree with it. The average age of the Australian mortgage broker is way too high. So, you know, there's a natural, you know, cycle that people, as they start to move into their, you know, late 50s, 60s, 70s, start to think about retirement. So we've got a disproportionate number of people in that cohort.
Yeah.
It's becoming harder to get into the industry. And I think that's a terrible situation we're in, but it's a fact. It is just getting harder to be in the industry. It's also becoming tougher and tougher and more expensive to be a part-time broker. whether it be insurance, compliance, software fees, all these things, they've all been going up. If you're writing one loan every, couple of months, it used to work, but, the maths behind it now don't really work. So I think those are probably the driving issues. The final one, and this is again, and Sasha touched on this, when you go to these conferences, there are some very fine and quite sophisticated mortgage broking businesses out there. Stephen, you're part of one of them. These, when you look at them, they've all got different business models, but some of these businesses are coming very slick and very good marketing, very good systems, very good staff, and they're becoming very effective. So they will take market share. They will take.
I wouldn't have probably picked straight off the bat what you were saying about obviously the older brokers that you've got there, but those actually last three that you've given there, Nick, is exactly, if you ask me the question, basically what I would have said. Because the way I fundamentally look at it is with the growing market share of brokers reaching all-time highs, right? And that means that you've got a lot of obviously established business, which makes the barrier to entry obviously a lot harder to crack.
Sorry, Stephen. I'm so sorry to cut you short. But we have come to the end of our webinar. But thank you so much both for your insights. Thank you so much for everyone for attending, and we'll be sure to be in touch shortly with CPD points. See you soon.
Bye for now.
Thank you.
Thank you.